When it comes to investing in dividend stocks, you typically have two options. Either you can invest in stocks that offer much higher yields but little in the way of dividend increase or share price appreciation, like McDonald's or Johnson & Johnson. Or you can invest in stocks that offer much lower yields, around 1 to 3%, but can offer share price growth as well as potential dividend increases. A firm like Gladstone Commercial Corporation, ticker symbol GOOD, is one example of this. As you can see, since its founding, the stock share price hasn't experienced much action in terms of share price growth, and they haven't increased their dividend by more than a fraction of a penny since 2008. Now, in this specific circumstance, this isn't necessarily a negative thing. For starters, this company does indeed pay monthly dividends, which is fantastic for those of us who are more inclined to invest in businesses. It's also the kind of stock that retirees could be interested in because of its flatlining share price, which gives more stability than your more usual growth or technology stock. Therefore, there are many good reasons to own stocks that have been able to offer stable, high-quality yields. But as I often say in my videos, you should always allocate some of your investments to items that bring growth, regardless of what stage of life you're in or what investing approach you're using. Given that the average annual inflation rate in the United States over the past century has been roughly 3%, it will aid in adjusting for growing costs. I therefore decided to look at a few of the stocks in my portfolio today that have both strong dividend yields and share price and dividend increases since each stock's creation. Everything that I've looked at tends to indicate that these stocks may continue to expand, while there is no certainty of this. Having said that, let's move forward and begin. WP Carey, with the ticker symbol WPC, is the first company on this list. It is a real estate investment trust that is one of the largest diversified net lease rates and has spent nearly 50 years specializing in the acquisition of operationally crucial single-tenant properties in North America and Europe. This company has made investments in premium single-tenant industrial, warehouse, office, retail, and storage buildings that are leased for lengthy periods of time under net leases with built-in rent escalators. Furthermore, this lease has a triple net lease rate, which means that taxes and maintenance are the responsibility of the tenants. Their company currently gives investors a 5.09 dividend yield. They distribute dividends on a quarterly basis, and the most recent of which was for roughly $1.06 per share. If we extend the share price performance of this REIT since their IPO, it's pretty evident that this firm has been fairly well managed. As you can see, it is currently up 2.34% while this video is being made. This stock is actually slightly up for this year. There have been a few times when the share price hasn't increased substantially, such as from 2003 to 2008 and from 2013 to 2018. However, this firm has increased its dividend every year for the past 24 years. This company will become a dividend aristocrat the following year if it keeps doing as well as it has. Viewing their portfolio, there are a few aspects that, in my opinion, are particularly important to note, like the occupancy rate of 98.5% as of the first quarter of 2022, which is greater than average among rates in my experience, and the weighted average lease term of 10.8 years, which is really excellent. Consequently, the typical tenant operating a property from WP Carey still has more than 9.5 years left on their lease. This is a strong indication that the company's profits will be consistently high for many years to come. However, 10.8 is definitely one of the greatest rates I've seen. I've seen other rates that only have a wait of around 4 years, which may make things a lot more dicey. W.P. Carey is highly regarded for having an extremely defensive and recession-proof real estate portfolio compared to others. According to their most recent investor presentation, warehouse and industrial buildings make up nearly half of their portfolio. They also possess a lot of assets that often perform better during economic downturns, such as self-storage facilities, Spanish government buildings, and K-12 schools in the United States. Finally, after reviewing their financials, I see a lot of positive developments, but there is one area that worries me: adjusted funds from operations, which is, in my opinion, one of the most crucial lines in the income statement for an equity REIT. It indicates consistent yearly growth in rental income, but their book value, which is currently $39.99, is another crucial indicator for a rate on the balance sheet. This means that the stock is currently trading at a significant premium for this company, and given that it is currently trading close to its all-time high, I genuinely believe that it is currently a little overpriced. Now, a stock trading above its book value isn't necessarily a bad thing if there is significant growth, but the firm's book value hasn't increased significantly in recent years. Another strong reason for the stock's high price is that it will soon become a dividend aristocrat. I could be mistaken, but I'm not currently purchasing any additional shares of this company in the hopes that the share price will decrease merely a little. Let me know in the comments if you have any other questions about investing. Let's return to the video. Hercules Capital, ticker symbol HTG, is the next stock. Hercules Capital is a business development organization that provides venture debt, senior secured loans, and growth capital to privately held venture capital-backed enterprises. They prefer to focus on the technology, renewable energy, and life science sectors, and normally look to invest in businesses that have been in operation for at least 6 to 12 months previous to the date of their investment. Hercules loves to spend between $10 million and $25 million into each business they work with. Their stock now has an extremely high dividend yield of 9.1%. Google claims that they distribute dividends on a quarterly basis. Their stock price is currently down roughly 12.5%, which is better than the S&P 500, which has lost more than 17.5% of its value since their start in 2005. Prior to the market crash in 2022, their share price increased by an astounding amount for a BDC. Hercules stock's share price has increased by more than 31 since its initial public offering, and it has increased by more than 14 overall from its start. Additionally, you can see that they were able to raise their dividends over the last 10 years, and they occasionally pay a special dividend that is pretty wonderful. Hercules Capital stands out from other BDCs in a number of ways, including the fact that its debt portfolio is composed of 94.7 variable rate loans. This implies that if interest rates climb, the corporation will profit more from its debt portfolio, potentially increasing revenue. Although it's not always a good thing, given this company's track record, I believe it will be advantageous for them. On the other hand, it might also imply that more businesses could potentially default on their loans. Additionally, they avoid investing in industries like oil, gas, metal, and minerals that many BDCs shun due to their volatility. As was already noted, the majority of their investments are in the technology and science fields, and the majority of their debt is derived from the drug development and software industries. Investing in firms like DoorDash, Lyft, 23andMe, and Impossible Foods is among their most well-known ventures. Their research investments are also quite interesting, as many of these businesses develop cancer and other disease therapies. Additionally, they have a sizable number of eco-friendly businesses in their portfolio that work in the renewable energy and sustainable energy industries. I also like that Hercules Capital is an internally managed business development company, which is another quality of BDCs. There are essentially two types of businesses, those that are managed internally and those that are managed externally. The primary distinction is that externally managed BDCs like Prospect Capital employ a different firm to handle its investment management. Although less money is returned to shareholders and fees are typically greater, not all BDCs that are externally managed are bad. However, Triple Point Venture Development is one that I particularly appreciate, albeit I do favor internally managed ones. The net asset value of Hercules Capital has also increased through time, which is a very significant indicator of management's success in building the business up to this point. Ares Capital, ticker symbol ARCC, is the third high-yield stock on this list to have both dividend and share price increase over time. This company specializes in the acquisition, recapitalization, restructuring, and leveraged buyout transactions of middle-market businesses. It is also a business development company. Ares Capital, which owns first and second lien debt together with subordinated loans and preferred equity, often invests between $20 and $200 million in businesses with EBITDA between $10 million and $250 million. Ares Capital was founded in 1997, making them one of the more experienced business development firms in the sector. Their stock also offers investors a very high dividend yield of 8.59%, and they have been paying dividends on a quarterly basis since their initial public offering in October 2004. The price of an ARCC share has increased by more than 27. Actually, their overall share price gain from their founding was above 38 before 2022 arrived. While this company did have to reduce its dividends during the financial crisis of 2008, it has been able to grow it steadily while also distributing the occasional special payout. Ares Capital is my preferred business development organization, as I have already stated numerous times for a variety of reasons. They are currently the biggest BDC in the sector, and as they say in the business, size does matter. They have a very lengthy track record of providing excellent returns on their debt investment portfolio. Despite having a well-diversified portfolio and holding a large amount of senior debt, which is thought to be the safest type of debt, it is still not completely risk-free. Ares Capital's portfolio, which included 395 portfolio companies backed by 200 different private equity sponsors as of March 31, 2022, had a fair value of approximately $19.5 billion. Since their IPO, the portfolio has generated an annual share price return of 3.5%. However, if you exclude this year, the return would actually be a little higher. On their website, they have a graph that displays their cumulative core earnings, net realized gains, and dividend declarations. Main Street Capital, ticker MAIN, the following stock with noteworthy growth and dividend increases, is also publicly traded. A business development organization called Main Street focuses on providing equity capital to lower middle market businesses. They also offer middle market businesses debt capital for acquisitions management, buyouts, expansion finance, recapitalizations, and refinancing. They make investments across a wide range of industries, including construction, machinery, healthcare equipment, and IT services. Their website states that they normally spend between $5 million and $50 million every debt investment deal. Regarding dividend payments, the history of Main Street is particularly impressive. There has never been a time in the company's history when the dividend had to be cut. This business survived both the flu pandemic and the financial crisis of 2008 without ever having to cut their payout. This is unequaled by nearly every other BDC. Yet Main Street has managed to keep their dividend throughout the years, expand it, and occasionally distribute special dividends to shareholders. There is no assurance that they won't succeed, but so far they have a strong track record, and in my opinion, their debt investment portfolio is one of the most diversified in the sector. They have investments in a wide range of industries, including software, aircraft, construction, and others. They have interests in industries that I don't particularly favor, including hotels and the oil industry, but these holding accounts for a very, very small portion of their total holdings. Again, this is ideal for diversity because the majority of their investments account for less than 1% of their income. Main Street's ability to historically outperform the S&P 500 by a rather considerable margin dates back 14.7 years, to the time of the company's initial public offering. An investment of $10,000 in Main Street would have significantly outperformed an equivalent investment in an S&P 500 index fund. Realty Income and Hercules Capital are two other high-yielding dividend stocks that have performed significantly better than the S&P 500, regardless of whether you decide to reinvest your dividends or not. I understand that this is all historical data and that we can't predict the future. But knowing this gives me more faith in the leadership of this business. Because Main Street Capital prefers to invest more in equity than some other business development businesses, we can see a lot of really wonderful things happening with this company when we look through their financial accounts. Compared to most other BDCs, it has enabled them to grow much more quickly. The management team at Main Street has been doing a pretty exceptional job up to this point, but we can see a long ongoing trend of increasing book value, which, as I mentioned before, is probably one of the most important metrics when analyzing a BDC. However, holding more equity investments is riskier than senior secured debt. We've now finished looking at some stocks that offer a mix of large dividend payments and growth in share price and dividend distributions. Overall, I still think highly of this company, and I've been quite pleased with the returns I've received so far. If you happen to have any of these stocks in your portfolio, feel free to leave a comment below. Always remember to conduct your own research and exercise due diligence before investing in any of these businesses. If you haven't done your own study and came to your own conclusion, don't blindly buy the same stocks I am. Also keep in mind that a firm is always free to reduce or cancel dividends if necessary. And with that, today's film will come to an end. Thank you so much for watching, and I truly appreciate it if you found it educational. Hope you have learned something from this video. What are your thoughts? Comment down below. If you enjoyed this video, make sure to click the like button, and also don't forget to subscribe to the channel and hit the notification bell for you to be updated on our latest videos. See you in the next video. Thanks for watching. Want to learn more and be more financially literate? Click on the next videos we have in our channel, showing on the screen right now.